Hi, it's Nero here, buyer's agent and director of Investment Rise. And today I want to look at the two opposing viewpoints when it comes to our current property market. Okay, so a couple of weeks ago I did an episode where I talked about why I expect the property decline, especially in our two biggest markets, to end soon. And I quoted some core logic data. And then almost the day after I released that episode, we saw this article. House prices to plummet by as much as 22.3% by 2023, NAB. So the question then is, when you see people like myself and other people in the property space talk about, the correction is going to end. And mind you, when we're talking about a price correction, we're really focusing very heavily on Sydney, Melbourne, and Canberra. Those markets are the ones where we're seeing the biggest impact of this so-called property correction. Okay, so when you see people in the property space talk about, okay, the correction is going to end, and then you see banks come out and talk about, oh my God, no, the correction is nowhere near over, you've got another 20% or so to go, it can leave you feeling very, very confused, okay? So in this episode, I really want to try and go through the rationale between both viewpoints and then give you a framework so that you can decide what you think is going to happen to the property market and then how to make your investing decision accordingly. Of course, nothing that I'm sharing is advice. This is just based on my now 20 years of investing experience and 12 years helping others buy property in different places around the country. Okay, now the first thing to consider when you're looking at these two opposing viewpoints, okay, is your own confirmation bias. Now, what do I mean by that? All right, well, if you already believe that the property market is going to crash, if you are convinced of that, okay, then of course you're going to actively start looking for evidence that supports it. Okay, and so when you see headlines like what I just shared talking about the property market crashing, that's going to be your evidence that you are correct. Okay, now of course you might be saying, but Nero, you are a buyer's agent. You help people buy property, buy investment property. So of course you're going to say that the property correction is going to end. Of course you're going to want to tell everyone it's going to be rosy. Okay, and I can see why you think that, but check out this from 2016, late 2016, where I was one of the few who came out and said, do not invest in the Sydney market, do not invest in the Melbourne market, because we're going to see quite a strong correction. And when I posted that episode, I got flogged online, right? I got criticized by so many people, forums, I got abusive emails, and yet just a few months later, we saw a correction begin that still to date is the biggest correction we have seen in the Sydney and Melbourne markets, okay? So for me, I'm very agnostic, and what I mean by that is I simply report on what the data is sharing, okay? And so I'm happy to talk about when I think the market's going to fall. I've done that in the past, as you just saw, and I'm happy to talk about when I think the market's going to rise, okay? So here I want to now go through both these two articles, and then at the end of the episode give you a framework so that you can see for yourself how to assess the future of the property markets to make your investing decisions. So let's begin by looking at the negative article, shall we? So again, the headline was, house prices to plummet by as much as 22.3% by 2023, NAB. House prices are already plunging, but are set to take an even bigger hit next year, knocking hundreds of thousands off home values. House prices are set to plummet even further next year, with an overall drop of 23% in some states between 2022 and 2023, according to the National Australia Bank. Across Australia, most capital cities, apart from Sydney, will experience a brutal hit to house prices in 2023 after they shot up during the pandemic, the bank forecasts. Surprisingly, Hobart will suffer the biggest drop in house prices next year. And then the article goes on to talk about, how much Hobart is going to drop. Apparently Hobart house prices are going to drop 23% in the space of just 2 years. Melbourne will see an even bigger drop. Then Sydney, however, although it won't be as high of a percentage drop price-wise, apparently it's going to see the biggest drop in prices, okay? And it just goes on and on, painting a very negative picture. But here's the thing to consider. What is driving these predictions? Okay, and the only thing that I could see in this entire article that spoke about what is driving all these property prices to decline, it's not because people are selling because they can't afford their mortgage, okay? There is zero mention of that by the National Australia Bank in this article or any of the other articles where they've spoken about this, okay? In fact, many banks are of the opinion that most of their customers have enough buffer to be able to handle this period of slightly higher interest rates before they get used to the new norm and before maybe even interest rates start to fall at some point. Okay, so there's no talk about increase in foreclosures, people having to fire sell their properties. The only reason then that the NAB is saying that property prices are going to fall is this one liner in the article which says, higher interest rates are slashing buyers' borrowing power and are the key driver for falls in property prices, NAB noted in its quarterly survey. So what the bank is saying is that interest rates are rising, that is reducing people's ability to borrow as much, therefore they can't afford property prices, and therefore property prices are going to fall. Now, what do you think about that argument? Does that make sense to you? Okay, it might if we lived in a world where everyone still has to live and work in Sydney or live and work in Melbourne or one of the other major cities that this article refers to. But we know that's not the case, right? I mean, consider this. If you are someone who, when prices were rising rapidly because interest rates were so low, especially in our major capital cities, and you kept missing out and you couldn't afford a property. And now, when the market is nowhere near as hot, and yes, some areas are correcting, but you can't still afford a property because your borrowing capacity has dropped by more than property prices. Therefore, you are still unable to get into the property market. What do you think someone in that position is quite likely to do? Well, either they're going to give up and rent. That's part of the reason why rents are rising. Or what they are going to do is they're going to keep moving to lower priced areas. Okay? And that's why a lot of this doom and gloom, as I've said in the past, is really based on what's happening in Sydney, what's happening in Melbourne, what's happening in our more expensive capital cities. They don't really talk about markets where property prices are still under $700,000, under $600,000, where there is an excess of people looking for good quality property and not enough stock available for the market, where rental returns are really, really strong. Okay, these articles don't talk about those particular markets, and if you're a property investor, dare I say it, those are the markets you should be targeting. Okay, but let's come back to this particular article, and it talks about, as I said, interest rates rising, culling people's borrowing capacity being the key driver why property prices are going to fall. Okay, now let's have a look at the article from CoreLogic. House price correction could be over by early 2023. CoreLogic. CoreLogic National Research Director Tim Lawless tipped the housing market correction to bottom out in the first quarter of 2023, followed by a swift recovery after the rate of house price decline eased slightly in September, according to the firm's monthly index. By the way, looking at some of the CoreLogic data already for October, we're seeing the rate of decline slow further. Okay, but let's just stick to where we are with this article. All right, it then talks about the Melbourne market being the weakest market, which is essentially what almost everyone is agreeing right now. The article then goes on to talk about the various markets again and how much they have dropped. Okay, but here's the key thing. Looking at the housing market more broadly, Mr. Lawless said other indicators such as subtly rising auction clearance rates, improving consumer sentiment, and a lower listing environment in spring correlated with the possibility that the correction may be easing. So you literally now have two experts telling you the opposite thing and giving you different evidence for their conclusion. So it's so easy to be confused, right? And it's so easy to then just say, I'm going to sit on the sidelines and I'm not going to do anything. But the question then is, what if the person who you believe is wrong? So here's what I want to share with you to maybe give you a bit of a framework as to what I think is going to happen to the future of property prices. And it begins with the fundamentals, which is this. What is the key factor that drives property prices higher? Okay, it is demand over supply. All right, and demand, how do you quantify demand? You can quantify demand by looking at buying activity. Okay, it's very important that it's buying activity, it's not rental activity, it's not the rental market. Now, of course, if there are other factors in play, the rental market, a strong rental market, can be a precursor to property prices rising, yes. But the key thing you want to look at is buying activity. Now, how do you look at buying activity? Well, you look at auction clearance rates in markets where a lot of properties sell at auction. Are auction clearance rates on the increase? In some suburbs, they already are. What's consumer confidence or consumer sentiment like? So what that means is, if you look at a lot of consumer sentiment surveys out there, they'll tell you, well, what are people thinking about in terms of whether they think now's the time to buy a house or not? And you'll see consumer sentiment on the increase. And normally, when you see consumer sentiment on the increase, that's a sign that buying activity is going to increase sort of 3 to 6 months later. Okay, so that's the second thing. Thirdly, you want to see, well, are certain properties on the market, are they taking longer to sell, or are they starting to take shorter times to sell? Okay, and so you want to look at the time on market as well. And when you start looking at these indicators on a suburb by suburb basis, that's the key thing here. Okay, all these articles, they generalize everything, but remember, when you buy an investment property, you're not buying in the Australian property market, you're not even buying in a state property market, you're not even buying in, say, the Sydney or Melbourne property markets, or Brisbane or wherever. You're buying in individual suburbs. And when you can find individual suburbs that show increased buying activity, and right now there are plenty of suburbs out there, especially priced below the national median price range, which, by the way, as an investor is great because it allows you to get into property at a lower price, get a stronger rental return, okay, and then have a really good chance of some significant capital growth, okay? But the fact is that if you look at individual suburbs, you will see that there are suburbs out there where there's increases in buying activity. You find those suburbs, you target those suburbs, as long as, of course, they meet your goals, your affordability, all of that. Then here's what I can tell you. You don't have to worry about this so-called housing price correction. It's not nationwide, okay? It is all about understanding that most of the journalists who are producing these negative articles, they're based in Sydney and Melbourne. So their research is skewed by their perspective. That's fine. You just need to be aware of it, and don't let that be the basis of your investing decisions. Instead, look at the data. Look at where you're seeing suburbs with increased buying activity. Those are the suburbs that are going to give you the capital growth that you're looking for. Those are the suburbs that you want to target right now. And when you find those suburbs, you'll be very pleased that you got into the market when everybody else was sitting out because of these negative headlines. Hi, it's Nero here again, and thanks so much for watching. If you like what you saw and you're looking for a proven recipe, a blueprint on how to build a property portfolio that gives you passive income, then click the link below this video and get a copy of my book, Wake Up Wealthier: How to Build a Property Portfolio That Pays You an Income Each and Every Month. Okay, when you click the link and you download your book, you can get both the digital version and the audio version in case you don't like reading. All right, so I used to sell this book for $49, but right now I'm making it totally free. Why? Because I want more people to get this information, and I know that a segment of you will then like what you see in the book and choose to reach out to find out more about our services. But even if you don't, if you're serious about building a property portfolio that pays your passive income, then you really want to get my book, Wake Up Wealthier. It contains the secrets that I have fine-tuned over the last 19 years. It's totally free for a limited time. Click the link below.